started. My name is Kimani Woods, and I am the communications manager here at Timewise Financial. And we're so excited to unveil the curtain to you guys and let you into our investment strategy as well as our firm's process. We are extremely excited to show this to you guys, and just as a way that you to give you the opportunity to see more behind the scenes of what it is that we do for you. Uh, there are a lot that's happening right now currently. And so, whatever it is that comes, we just want you to be aware that we have your back and that we are by your side in whatever it is that comes. So, Matt, also, if you guys have anything that you want to ask, you can do so using the Q&A down in the menu at the bottom. All right, Matt, you ready?
Yeah, awesome. Thanks, Kimani.
Thank you.
All right, so this is a pretty meaty presentation. So I hope you guys brought your steak knives. That being said, as Kimani mentioned, as we're going through this, if a question comes up, feel free to pop it in the chat. We'll either address it then or hit it at the end. But the goal of this presentation is really to show you guys how the sausage is made. So typically when we talk investment accounts and strategy with you guys, we keep it very high level purposefully. We try to keep a 30,000-foot view, not get too in the weeds so that it's digestible and you can fully understand what's going on in your accounts. But let's go ahead and jump in. And so today we're going to cover just a brief summary of what you get access to, our team, our investment philosophy and core beliefs, really how we invest, and then our vetting process, essentially how we build out the portfolios. So without further ado, we can jump in. So firstly, we just want to highlight, when you work with one of the advisors at TimeWise, yes, you get access to their value, their expertise, their credentials, but we've built a team with decades of experience between Sherry and Teresa managing inquiries that come in, or account updates or address updates when you move, any of those life changes that occur. Kimani building all the marketing material, keeping you guys informed of what's going on both in the market and with the team. Obviously, Charles is amazing at operations. He makes sure that your money gets moved to the right place, your accounts get opened. And then we have our advisory team, and each of them has an area of expertise they specialize in. So one thing, if you ever worked with just a investment management only firm, a lot of times, if you have tax questions, for example, or you have questions about how a life change, an inheritance or a divorce is going to affect your investment and your overall lifestyle, they'll refer you out. They'll say, "Hey, I'm not a tax professional or a tax advisor. That's not really my area of expertise. I'm sorry, I can't answer that question." But by doing business with TimeWise, you get access to the full team and their individual expertise. So even if your advisor that you work directly with doesn't have the answer, they can lean on the resources that we've built here at TimeWise to make sure that pretty much no matter what comes up, you've got a solution. So additionally, I wanted to just highlight the parties involved with investment relationship with TimeWise. So you've probably heard these names, but didn't really know how they worked together. So first, you have the individuals you work with here at TimeWise. We are your financial quarterback. We manage your plan, we build out your portfolio, and we make sure that you're on track to achieve your goals. But we need infrastructure as well as checks and balances to make sure we can provide that service to you. So there's two other parties that are part of this transaction. One is our broker dealer. So Avantax, as you might have heard, merged with Cetera in September of last year. It's very rare that our clients ever interact directly with Cetera. Primarily, we interact with Cetera as they help us maintain compliance. There's a ton of compliance from FINRA, the SEC, both on marketing materials and investment recommendations that we have to be sure to follow. And Cetera is almost like our mom and dad in that regard, in the sense that they make sure we're doing everything that we should be in your best interest. And then also there's NFS, National Financial Services. That's a company that's a subsidiary of Fidelity. So literally when we go log in to place trades, we're logging in to Fidelity and they are routing the buy or the sell order to the New York Stock Exchange or the NASDAQ so that they essentially provide the tech infrastructure to custody or provide a holding place for your assets, as well as the insurance that comes along through SIPC to ensure that your assets are safe. So your assets aren't custodied by Timewise in Atlanta or Denver. They're custodied by the full faith and credit of Fidelity Investment Company. That being said, by working with a company like Cetera and choosing NFS as our infrastructure for where we custody your assets, that allows us to be considered an independent advisory firm. So we are independent advisor representatives that work in your best interest, and the benefits of working with an independent firm are broad, and there's quite a few. I'll hit a few of these. So one, a lot of times if you work with one investment company, you think if you were to go directly to Fidelity and get an advisor at Fidelity, one, they're not going to have the team behind them to offer the additional expertise that we provide. But two, in many cases, they're kind of pigeon-toed into recommending Fidelity funds. And they don't necessarily look at the broad world of nearly 19,000 mutual funds, 8,000 ETFs. There's a lot of options out there. And some companies are better at bonds or for international investing than others. And they don't necessarily get access to every single option. Oftentimes, you might hear firms that you are more akin to relating to insurance companies, but they're offering investment services. And those type of firms oftentimes aren't fee-based like us, and they sell commissionable products. We operate with a fiduciary standard, which it by definition means any recommendation or change that we present to you, it has to be in your best interest. And there's a few different layers of ethical compliance guidelines that we're forced to follow. The most stringent being the CFP or the Certified Financial Planning Board, which the majority of your advisors here at Timewise hold the credentials for. Additionally, because we're not working for a bank or a big wirehouse, there's no sales quota or target that we have to hit to where we're always focusing on the next client. We, by kind of having substantial and lasting relationships with our existing clients, it ensures that they get the best service possible. We're not building any proprietary products that don't have any track record or proven back testing. We're going out into the market and finding the best of the best before they enter your individual portfolio. Oftentimes, if you're with a much larger firm, the advisor that you got accustomed to working with or the team that you got accustomed to working with will either move to a different company or get a promotion. And by working with a team like Timewise, you get a dedicated long-term relationship with the individuals here on our team. And we've already hit the fact that those benefits allow us to provide fully customized portfolios. So each and every portfolio is tailored to your individual goals and needs. Additionally, how we are compensated, we already kind of hit on that, how some companies are compensated by commissions. And sometimes what you'll see with that is a big check up front when they sell you a product, and then they have no vested interest once they've collected that commission to continue to service you as a client. We're fee-based here at Timewise, which basically means we have a vested interest in two different outcomes. One, obviously, when you grow, we grow, as our fee is based on the number of assets you have invested at Timewise. So we have a vested interest in making that number go up. But additionally, we have a vested interest in limiting how much you lose during market downturns because when you feel market drops, we feel it too. So we're essentially all in this boat together. That being said, our investment philosophy is based on a few tenets and core beliefs. So, one being time in the market is always going to outpace timing the market. Two being that by providing a diversified portfolio, we can ensure that no one single outcome, think a invasion into a oil producing country or a president being overthrown or a global pandemic or a company having a bad earnings report. No individual one outcome is going to derail your overall plan because you have a broad array of investments within your account. And lastly, protecting capital is just as important as growing it. So oftentimes we can win more by losing less as we're building our portfolios. And those are kind of the basis of how we start to form our decision making. I'd say how we really differentiate from, other investment firms or advisory firms is one, our continued monitoring. So we meet with our clients at least every other quarter and we evolve their plans as their life changes. We've had many clients that inherit assets from a family member or have a passing in their family or lose their job more quickly than they anticipated. And we are available there to quickly adjust their overall plan that we've built to adapt to whatever life throws at them. And then lastly, a big focus for the whole advanced tax channel and Timewise in particular is tax efficiency. So it's great that we provide a well-diversified portfolio of investments for you guys, but we also, more so than I think any of our competition, look at any changes we make or adjustments or recommendations through a tax efficiency lens. So when we're trying to determine, where do you get that $4,000 a month in retirement to supplement your income and ensure you don't run out of money, we're also considering, well, which account type should we take it out of? What are the tax implications of a rebalance going to be? And all those decisions, I think, allow us to have an advantage in the services that we provide. But we didn't just pull these principles and beliefs, out of the air. We built our investment principles on decades of academic research. So there's core principles when building out investment models that are time tested and built by people, admittingly probably far more smarter than anyone here at Timewise with Nobel Prizes and decades of experience at some of the best business universities in the world. And some of those principles that base our decision making are things like markets are efficient. Really, what that means is you could say, hey, Iran was just hit with missiles and it's disrupted the oil market. I want to trade this action. I think that's going to make U.S. oil companies appreciate. But the fact of the matter is that investors as a whole, back in June, when the U.S. started to deploy additional F-22s and military infrastructure to the Middle East, already started to price in the probability that something's going to happen in Iran. So it's really hard to beat the market because information is efficiently priced into the market. Some of those other academic principles that found our decision making are based on studies on behavioral finance. So I think some of the best value we add for clients is when things get scary. I remember myself back in 2020, I was in the hospital with COVID on March 13th, just before the shutdown. And there were 2 days in a row where the market was down nearly 8% and 12% in single days. And the news media was very uh, catastrophic, for lack of a better word. And those were scary times for sure. But we were able to provide content and historical evidence, even tying back some similes to the Spanish flu of 1918 for our clients and show them, hey, 5 years from now, will we be able to build a portfolio that's resilient enough to weather this current storm we're powering through? And it allowed our clients to hold steady and make better or more informed decisions when it came to their investments. We also want to protect against sequence of returns risks. Many of you guys have probably heard of this with our bucket strategy, but we can build out a perfect plan for someone to retire in 2 to 3 years from now. But those first few years in retirement are very contributive or detrimental to the overall performance of a retirement portfolio. Think about, you might know of someone who retired in early 2008, just before March of 2008, and thought they were in great shape. And then next thing they know, they didn't plan correctly, and a huge disruption may have even forced them to go back to work. These other principles kind of build upon diversification and the power it has for portfolios. And the last piece that I'll touch on that bases our decision making is this capital asset pricing model essentially looks at the least risky assets, think like US Treasury bonds, and helps us try to determine how much additional reward relative to a US Treasury bond should we be expecting from a particular investment based on how much additional risk that individual investment has relative to a Treasury bond. So all of these academic principles basically build out the philosophy and core beliefs we have here at Timewise. So if you've worked with us, especially if you've onboarded in the last few years, this will probably be very top of mind for you. But before we even make an investment recommendation, we like to get to know your full picture. It's really hard to make tax decisions without knowing your income and projected income in the future. It's really hard to make investment recommendations without knowing your goals and your timeline and your risk horizon. It's really hard to give you a recommendation as to when to retire if we don't have a full picture of your assets and the income it requires for you to get through your retirement. So we basically gather all this data and start to build a plan before we build a portfolio. That being said, two of the biggest contributors to the recommendations we make are time horizon and risk tolerance. So I often use the analogy, you don't want to take next month's rent money and go to the casino with it, because if roulette doesn't hit black when you're betting black, you're now not going to be able to afford rent next month. So money that you need in the short term, you don't necessarily want a ton of risk with. So depending upon when you're actually going to need the funds that are part of your portfolio, we tailor the portfolio accordingly, as well as how much risk you share with us you're comfortable taking. So an individual, no matter their age, if they know themselves and do not feel comfortable losing more than a certain amount, we can back test the portfolio and build out a statistically relevant portfolio that is built tailored to their relative risk tolerance. That being said, we've kind of went a step further with this time horizon recommendation. And we really feel like having intentional assets help clients weather storms. So many of you guys, especially as you've approached retirement or entered retirement, have probably been exposed in one way or another to this bucket strategy. Each person's bucket strategy is a little bit different, but it's made up of 4 to 5 core tenets. So we can't invest substantially until we have an emergency fund covered off. And usually that's 3 to 6 months of your expenses. And it's one for peace of mind, and two, just to cover off anything the world could throw at us in the short run. Additionally, as we get into retirement planning for you, we want to bake in any reliable sources of income. I like to call this mailbox money. No matter what happens in the world, you'll walk out to your mailbox every month and have a check from either Social Security or a pension or other source. Then we like to build out a conservative section of your portfolio that is, I like to say, instead of being on a roller coaster ride like Goliath at Six Flags here in Atlanta, which is a very intense roller coaster, the intention for these assets is to be more of like a carnival ride where there's not huge ups or huge downs. And what that conservative bucket allows is a bridge before we really have to tap in into your more growth oriented assets in the event of a market downturn. So through an abundance of research all the way back to the 60s, we determined every single market pullback. You think about Black Tuesday, the dot-com bubble, 9/11, 2008, the market had tanked and then recovered within 5 years. So that conservative bucket, when necessary, is a really powerful tool for clients, especially if they're in that withdrawal phase. And then the last piece is we like to determine whether you can self-insure or perhaps seek out other ways to cover off any major long-term care events that could happen well later into life. So we can build out these buckets, these first 4 buckets, and have a very well-funded plan. But we've seen scenarios where at age 84, expenses go from $4,000 a month to $10,000 a month for an individual because all of a sudden they're diagnosed with something like Alzheimer's or dementia and need memory care support, which is much more expensive than their standard living expenses. So when we're building out our plans, we also want to cover off in one way or another for some of those more probable what ifs. That being said, then after we start to build out your plan and build out your buckets, we have to decide, well, what actually goes into each bucket. So we start from the top. We do our own market analysis, assess economic conditions, where interest rates are most likely to go. Additionally, we take in research from both portfolio management companies and Cetera's investment management team. They have a team of 20 certified financial analysts that provide daily research that help us basically establish our assumptions. So after we've performed a market analysis, we like to basically set some probable outcomes. We call these capital market assumptions. And this is essentially, hey, a range of outcomes that we can expect over the next 1 to 5 years. And we use those assumptions to make investment decisions. Now at that point, we can start seeking what actual funds are going into the portfolio. So we begin our investment vetting process, which we'll touch on further here in just a second, and start to build out a portfolio that's stress tested and has an optimal risk to reward ratio for each of our clients. Before we get into individual security selection, though, we also have to decide, is active management or passive management more appropriate? And it actually varies depending on the individual category of investment. But the way I like to explain the difference between active and passive investing is, so passive investing would be like an investment in the NFL, the league as a whole. You have access to every team, every hot dog sold, every ticket sold, every jersey sold. You got a little piece of everything. And it's just kind of set it and let it ride. You're just trying to mirror the overall performance of the league. And when the league does well, you do well. Whereas active investing on the other side is more of like hiring a professional analyst to watch stat lines and see which particular player was out Saturday night before the game on Sunday. All of those individual, potentially statistically relevant factors that could shape the outcome of a game and therefore a team and therefore the league. And you get a little bit more specific with how you're making investment decisions. So, this is kind of a summary here on the left of all the different categories that we then go look at to try to start to assemble portfolios. We have to manage that. This is some data. I won't get too in the weeds with you here, but we have to analyze historically, is there particular asset classes where active actually historically does better than passive. And if you were to look here, you could see there's a few asset classes, potentially like high yield bonds or diversified emerging markets, where active actually pays off. And so we tailor our search to those findings. But we also, based on back on these capital market assumptions, we then have to determine, hey, we want a little piece of every one of these categories potentially in the portfolio. But for a moderate investor or a conservative investor, how much US large growth do we want? How much US small value do we want in the portfolio? And that's where we start to make our weighting decisions. So once we've kind of got our capital market assumptions, our sector selection or asset allocation, and we've decided where we want to go active and passive, this is where the fun part starts to start. And it's not just me or Caroline or Deanna or any one advisor making these decisions. It actually goes through a three-tiered filtering system. So we here at Timewise will do our own research. We'll meet with portfolio managers. We'll go to due diligence conference around the country to learn about individual companies, think like Invesco or Fidelity, what their capital market assumptions are and what they are doing in their individual investments. Additionally, we lean on that 20 plus team of credentialed CFA analysts that provides research on funds that are available in the marketplace and additional monitoring. And then lastly, as we're continuing to filter down, we also verify and stress test each of these asset classes to determine really the best of the best and what actually makes the cut to get into the portfolio. So once we built out a portfolio, weighted it accordingly to our capital market assumptions, and then also weighted it according to your risk, we don't just press pause and let it ride. We continue to monitor that account and make adjustments. So every quarter we review the current allocation. We'll make adjustments, let's say, for example, last year we made adjustments in accounts where risk was appropriate to add additional international exposure because the international market had basically not performed substantially in 15 years, and the US market had done exceptionally well over those 15 years, and you could get really cheap stocks overseas. This year, we're looking at things like interest rates. We got a new Fed chair. Jerome Powell is going to be out, and we've got a new chair coming in. And we're going to have to try to determine how many rate cuts can we expect, and are things like increased oil prices going to drive inflation and reduce the ability for rates to be cut. After we've reviewed each quarter, though, and analyzed, oftentimes we make adjustments. So the beauty of quarterly rebalancing is we're kind of keeping it simple in a way by buying low and selling high. And what I mean by that is, let's say Nvidia, an AI company, has done really well last quarter, and it's done so well relative to some of the other investments in the portfolio that now it's, instead of 4% of the portfolio, 8% of the portfolio, just to use round numbers. We will actually go sell that position that's done exceptionally well and look at where to reallocate the proceeds in a position that may be artificially beat down for a season. You think about it, it could be healthcare due to reimbursement rates for Medicare that are getting negotiated, and the market's trying to predict where those are going to be at, and we think it's a short-term problem. It could be a number of things, but we adjust the portfolio quarterly, and we're basically selling those positions that have done exceptionally well and become too contributive in terms of risk to the client's goals, and buying those positions that maybe are having a bad season, but we have the data and the filtering and all the analysis that we just covered to determine, hey, over the long run, is still in a good position. But we're not just trading willy-nilly, and especially in after-tax accounts. Well, I think non-retirement assets, we really have to make those decisions with a tax-aware lens. So throughout the year, we also may harvest losses within those after-tax accounts to offset gains. And it's not like we're doing all this behind closed doors either, because you get trade confirmations as well as monthly and quarterly reports where you can view, hey, what's my account in now and what's changed. So, relative to some firms out there, we're not just doing investment management, though. So, for those clients that elect to do so, we offer in-house tax preparation. Whether they prepare their own taxes or do it with us or elsewhere, we already hit on that strategic tax planning we do for clients. We also perform beneficiary reviews and review titling across all the accounts and give estate planning advice. We build out those retirement plans and determine when clients can retire and how much more they may need to save to successfully do so. Once we get into retirement, or even prior to retirement, we may find some budgeting concerns, and we may say, hey, you can either cut back expenses, work longer, or save more. But also, once we get into retirement, we want to analyze that cash flow and determine the tax ramifications and the most efficient source to provide the income needed for the client's retirement. And while we don't really sell insurance very often, other than maybe some insurance to cover a long-term care peril, we are always happy to review clients' life, auto, home coverages, and make sure they have adequate coverage as a part of the plan. So beyond investment management, we still do a lot. I wanted, though, to quickly just look at a example scenario. So March Madness is kicking off today. You may get this in a little quip or not, but I chose to use Tar Heel Ted and Duquette, two rivals in March Madness, UNC and Duke. But they've got a complex scenario. They've got some assets. They've got a daughter who plays golf pretty competitively. She got an NIL deal to go to the University of Virginia against her parents' wishes. They know in their head they want to retire in 3 to 5 years, but they really aren't sure if they can afford it. They are concerned about long-term care costs, as Alzheimer's has ran in their family, and they know how expensive that could be. They are concerned that, hey, maybe we don't have enough. We might run out of money. They're concerned about covering off health care before age 65 because they won't have access to Medicare until then. They're really concerned that, hey, what happens if the market tanks, the day after we retire? And they realize, hey, we don't really have a written plan for any of this. So by having access to the Timewise team, they have a team that can provide expertise on navigating Cavi equipped for the Cavaliers at UVA's NIL deal and how to navigate that tax efficiently. I didn't hit on this, but Tar Heel Ted mentioned he's owns an architectural firm and wants to get out of there as he approaches retirement. They have access to a team that can analyze offers and calculate the most tax efficient way to basically exit that business and how to invest the proceeds in a tax efficient manner as well. And so as they're coming on board as clients, before we even build their buckets or build out their portfolio, we're going to be analyzing projected retirement income, with their Social Security and the income their assets are projected to throw off per year in a portfolio built to their risk tolerance. Can they afford to retire? As they're getting that money to provide for the retirement, what's going to be the most tax efficient source for those funds? As they're building out that business succession plan for his architectural firm, ensuring what the approximate value of that business is and how they might structure that deal, whether it be creating more goodwill versus tangible assets, or just structuring in a way where they can minimize the tax implications for Tar Heel Ted. We're going to determine, can they self-insure through the equity in their home or the assets they've accumulated long-term care, or they need some additional coverage to cover off that peril. We're going to ensure that they're cutting on Social Security at the same time, as well as perform an estate and beneficiary review to make sure if something happens to them, their heirs are in excellent shape. So as you can see, by working with Timewise, just to recap, we'll take it from the top. You get access to an amazing team, an amazing tech platform that safely custodies your assets, some pretty decent investment strategies at an independent advisory firm, a fee structure that's in your best interest, academic foundation for the decisions we make. We take into account your overall picture first, and most importantly, analyze your time horizon and your risk tolerance. We build out buckets when necessary to ensure that you're positioned to weather any short-term storms. We filter the assets before they go into your portfolio, both through capital market assumptions, active versus passive research, as well as our three-stage vetting process before that actually enters your account. You get continued rebalancing and adjustments with a tax efficient lens applied, as well as these other benefits that we covered earlier, all in one stop. But the last thing I'll hit on is, once we build out this plan for Tar Heel, Ted, and Duquette, it's not like we just assume our recommendations are definitely going to work. We use our financial planning software to essentially run some scenarios and say, hey, this is the plan we built, but what's the probability of it actually working? And it includes scenarios like market crashes, 2008 style. What if they live longer than they anticipated, or inflation's higher than they initially forecasted, or they do end up having a long-term care event, or they retire earlier than intended, or that business sale doesn't go through. We can start to basically put the plan we built to the test. It's great that we built it and we think it's going to work, but what does the data actually say? And so by running what they call a Monte Carlo, we can basically run 1,000 or 10,000 different scenarios, where some of the market does really good early and does worse late, or really poorly early and better late, or any combination between the two, and really determine how many potential scenarios are there where they do run out of money. And then we can start to plan accordingly. So that was a dense presentation, and I'm happy to dive deeper into any of the slides we covered. But if any of you guys have questions, now would be the time. The last thing I'll say is, the whole idea behind Timewise, hence the name, is by doing all of this on your behalf and being engaged with you guys as clients, we basically provide you guys the more valuable asset than the time you could be spent doing all this yourself. And that's spending time with families or other individuals that are important in your life. So that being said, have we had any questions come up, Kimani?
So I have not seen any questions come through. That was a great job. And we know that a lot of you guys have experienced what it means to work with us, but we hope that seeing all of this in one presentation, that it just brings it even closer to home for you. All that it is, the time and the care that we put into making sure that you and your families are provided for. So yeah, I do not see anything here. And we thank you guys so much for your time. We greatly appreciate it. And we are extremely excited for our next meeting with you. And if you have any questions, please email us, call us on the phone. You know that we're always here for you. So thank you so much. Enjoy the rest of your day.